Picture this. You're on the sofa, phone in hand, thumb scrolling, without really thinking about it. Someone in your feed is bragging that their portfolio is up 30% this year, and something in you thinks, right, I should probably sort this out. So you download a trading app, you open it up, and straight away you're hit with a wall of letters and numbers. PE ratio, market cap, dividend yield, bull market, bear market. Your thumb hovers over the screen. You freeze. You close the app. You tell yourself you'll figure it out another day. Here's the thing about another day. It never actually arrives, because the whole language of the stock market feels like it was built on purpose to keep ordinary people locked out. That changes today. I spend way too much time thinking about why nobody ever taught us this stuff at school, even though it's genuinely the one skill that decides whether you retire comfortably or you're still working long after state pension age. If you're someone who knows you should be investing, but feels completely lost the moment you try to look into it, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's what most people don't realize. The stock market isn't complicated because investing is inherently difficult. It's complicated because the financial industry benefits from you feeling confused. Research from ABRDN's Savings Ladder Index found that people with poor financial literacy end up, on average, around £20,000 worse off in their pension pot than those with good financial literacy. That's a house deposit sitting there unclaimed because nobody ever sat you down and explained what a share actually is. So let's fix that properly right now. A stock or a share is, at its most basic, ownership in a company. Buy one share of Apple and you own a tiny sliver of Apple. Genuinely, actually own it. That ownership makes you money in two ways. Capital appreciation. The share price goes up, so buy at £100, sell at £150, you've made £50. Or dividend payments companies make to shareholders out of profit. Some pay them, some don't. Here's the psychological shift most beginners miss. When you own a share, you're not gambling on a ticker symbol bouncing on a screen. You're betting on an actual business. The warehouse, the staff, the product on the shelf. You're saying, I think this company will be worth more in future than it's worth today. That's a completely different mindset from treating the market like a casino. And it's the exact difference between people who build wealth quietly and people who lose their shirts chasing tips off a forum. Now, shares properly. A share is just the unit of stock owned, 1,000 out of 1,000,000, and you own 0.1% of that company. And the number of shares a company issues matters more than you'd think. Two companies can both be worth £1 billion total, but one splits that into 10 million shares at £100 each, and the other into 100 million shares at £10 each. Beginners see the £10 share and assume it's cheaper, which is completely wrong. The share price alone tells you nothing. What matters is the whole company's value and what you're getting for your money. Which brings us to market capitalization, probably the single most important term here. Market cap is the total value of all shares. Share price times the number of shares. Companies are grouped into bands. Small cap, roughly 300 million to £2 billion. Mid cap, up to 10 billion. Large cap, above that. And mega cap, like Apple or Microsoft, over £1 trillion. Here's what nobody tells you. Small caps are riskier, but a £500 million company can realistically double. A £2 trillion company simply doesn't have the room. Treating a scrappy small cap startup and a mega cap giant as the same kind of bet is the mistake beginners make. Shares trade on exchanges in the UK, mainly the London Stock Exchange, though UK investors regularly buy US listed shares too, through an ordinary broker. Nearly all exchanges today are fully electronic. The old image of a shouting trading floor has mostly gone. What hasn't gone is the hype a celebrity posts about a stock, and it jumps 20% for no real reason, which is why you need to understand the difference between trading and investing. Trading is short-term, trying to profit off price movement over days or weeks. Investing is long-term, buying businesses you believe will be worth more in 5, 10, or 20 years. Here's a stat that should surprise you. Long-running research into investor behavior has found the average investor consistently earns less than the market itself. Not because the market underperforms, but because people panic sell in downturns, chase whatever's hot, and trade far too often. Right, valuation. The PE ratio, price to earnings, tells you how much you're paying for every pound of a company's profit. A share at £50, earning £2.50 per share, has a PE of 20. Think of it like buying a business outright. Your local bakery makes £50,000 profit a year. The owner wants £1 million for it. That's a PE of 20 years of profit just to earn back what you paid. Good or bad depends on growth. A steady utility might sit at 10. A fast-growing tech firm might sit at 50 because investors expect its profits to rocket if that bakery is about to open 100 new branches. A high PE suddenly makes sense. Earnings per share, or EPS, is profit divided by the number of shares. Companies report this every quarter, and here's what's genuinely strange. A company can report brilliant profits, and the price can still fall if those profits weren't quite as brilliant as everyone expected. The market trades on reality versus expectation, not reality alone. Dividends are widely misunderstood. Own 100 shares, get £1 per share per year in dividends, and £100 will land in your account. But when a company pays one, its share price drops by that same amount on the ex-dividend date. You're not getting free money, you're getting your own money back in a different form. The trap beginners fall into is chasing a high dividend yield without asking why it's so high. £4 a year on a £100 share is a 4% yield. Let that share crash to £50 and still pay £4, and the yield's suddenly 8%, which looks brilliant until you realise the price might be crashing because the company's in real trouble and about to cut that dividend entirely. Buybacks work similarly to a company buying back its own shares, reducing the number outstanding and making each remaining share slightly more valuable. Same shareholder reward as a dividend, delivered differently. Bull and bear markets. A bull market is when share prices rise, generally by 20% from a recent low. A bear market is the opposite, a 20% fall from a recent high. Here's the psychological trap that wrecks beginners. Bear markets feel dramatically worse than bull markets feel. Losing 30% in 6 months is genuinely distressing. Gaining 30% over 18 months rarely feels as euphoric. That's loss aversion, and it's why people panic sell at the bottom and miss the recovery. Research tracking investors through the 2008 crisis and the recovery that followed found that those who simply stayed invested came out with solid long-run returns, while those who sold and sat in cash earned essentially nothing. A few mechanics worth knowing quickly. A market order buys or sells immediately at whatever price is on offer. A limit order sets your own price and only executes if the market reaches it. A stop loss automatically sells if a share drops to a level you set, useful, but a brief panic dip can trigger it right before a recovery, locking in a loss you didn't need to take. The bid is the highest price a buyer will pay, the ask is the lowest a seller will accept, and the gap between them is the spread that quietly costs you a little on every trade, which is exactly why day trading is so brutal. Volume is the number of shares traded in a day. A sudden spike usually means something's changed. Volatility is how much a price swings, and beta measures that volatility relative to the wider market. A beta of 1.5 means a share that's 50% more volatile than the market in both directions. None of this matters much if you're buying and holding for 20 years, but it's worth recognizing the terms when you hear them. Now, index funds and ETFs are arguably the single most important thing a beginner here can understand. An index fund tracks an index, like the FTSE 100, which comprises the 100 largest companies on the London Stock Exchange. Buy one and you own tiny slices of all 100 at once. Instant diversification. Buy 10 individual shares instead, and if one goes bust, it costs you 10% of your portfolio. Buy a broad index fund, and one company failing barely moves the needle because you own hundreds of others alongside it. Warren Buffett, one of the greatest investors who's ever lived, has said most people should simply buy a low-cost, broad index fund and hold it forever. His own instructions for his estate put 90% of his wife's inheritance straight into a low-cost S&P 500 fund. Here's the stat that should properly convince you. S&P's own scorecard tracking active fund managers in Europe found that in 2025 alone, somewhere between 8 and 9 in 10 actively managed UK equity funds failed to beat their own benchmark index, climbing past 90% for small-cap UK funds specifically. Professional fund managers fail to beat a simple index fund most of the time and charge you 1% or more a year for the privilege, while an index fund can charge as little as 0.03%. Invest £10,000 at 7% for 30 years, and a 0.1% fee leaves you with roughly £72,300. A 1% fee leaves you with about £57,400, almost £15,000 gone purely to fees. ETFs work the same way as index funds, but trade throughout the day like an ordinary share, rather than once after the market closes. Diversification just means not putting every egg in one basket, spread across hundreds of companies, so that one failing barely touches you. But owning 10 different tech shares isn't diversification if the whole tech sector falls together. Real diversification spreads across sectors too: technology, healthcare, financials, energy, and consumer staples, since different sectors thrive at different points in the economic cycle. Bonds are essentially loans to a company or government that pay regular interest and return the original amount at maturity. Generally less risky than shares, but lower returns too. Asset allocation, how you split your money across shares, bonds, property and cash, is arguably more important than which individual shares you pick. Landmark research into portfolio returns found that over 90% of the variation in performance is attributable to the overall split, not clever stock picking or market timing. Younger investors can typically afford to sit heavier in shares. Someone close to retirement leans further into bonds because they can't afford to lose a big chunk of their pot right before they need it. Pound cost averaging means investing a fixed amount at regular intervals, say £200 every month, regardless of what the market's doing. When prices are high, it buys fewer shares. When they're low, it buys more. And over time, you average out what you actually pay. It's ideal for beginners because you never have to guess whether now's a good moment. You just invest consistently, on autopilot, including through the frightening weeks when the market's falling and everyone around you is panicking, which is often exactly when shares are effectively on sale. Compound interest is famously called the eighth wonder of the world. It's earning returns on your original investment plus returns on your previous returns. Invest £10,000, earn 10%, and you've got £11,000. Earn 10% again, and it applies to 11,000, not 10, giving you 12,100. Every year, the base gets bigger, so the returns get bigger too. Here's the maths that shows why starting early matters so much. Person A invests £5,000 a year from age 25 to 35, then stops completely for a total of £50,000. Person B invests £5,000 a year from 35 to 65, £150,000 total. At 7% annual returns, by age 65, Person A has around £602,000. Person B has around £550,000. Person A put in a third of the money and still ended up with more purely by starting a decade earlier. Now, capital gains, the profit from selling an investment for more than you paid. Here's what actually matters for UK tax, and it's genuinely different from how a lot of finance content online explains it. Unlike some other countries, the UK doesn't care whether you held something for a day or a decade. There's no short-term versus long-term split. What you pay is capital gains tax. 18% if you're a basic rate taxpayer, 24% if you're higher or additional rate, with an annual tax-free allowance of £3,000 before any of it applies. Here's the part that should genuinely change how you invest. All of this disappears if your shares are held in a stocks and shares ISA rather than an ordinary account. Gains inside an ISA are entirely free of capital gains tax permanently, and you can put up to £20,000 into one every tax year. Fill your ISA first every single year before you touch a general investment account, and you shelter every pound of future growth from the taxman forever. There's also a UK rule worth knowing. HMRC won't let you sell a share at a loss purely to claim the tax deduction, then buy the same share straight back within 30 days. Specific matching rules exist to stop exactly that. A handful of terms worth recognising briefly. Rebalancing means nudging your portfolio back to your target split after one part's grown faster than the rest. Selling a little of what's grown, buying more of what hasn't, which forces you to sell high and buy low, even though it feels wrong. Fundamental analysis means judging a share based on the actual business revenue, margins, and management. Technical analysis means judging it purely on the price chart, ignoring the business entirely. For anyone building wealth over decades rather than chasing a quick win, fundamentals matter far more. Short selling and margin trading both let you bet with borrowed shares or borrowed money, and both can multiply your losses just as easily as your gains. Beginners should avoid both, full stop. An IPO is a private company selling shares to the public for the first time. Research consistently shows most underperform the wider market in their first few years, whatever the hype says. Every UK public company files an annual report and accounts, and any director trading on inside information before it's public is breaking the law, which the FCA actively enforces. Blue chip shares are of large, established companies with a long track record, such as Unilever and AstraZeneca, and are generally safer and steadier. Penny stocks trade for pennies in small, speculative companies and are genuinely risky. Most end up worth nothing. Growth stocks reinvest everything into expansion rather than paying dividends, betting on rapid growth. Value stocks trade below what they're believed to be genuinely worth, often paying dividends, with investors betting that the market will eventually catch on. Cyclical stocks, such as airlines, hotels, and construction, boom and slump with the economy. Defensive stocks, like utilities, hold steady regardless. The expense ratio is the annual fee of fund charges as a percentage of your investment. Index funds often sit below 0.1%, active funds a percent or more, and over decades that gap compounds into a genuinely enormous difference. Market timing, trying to predict exactly when to buy and sell, simply doesn't work consistently, study after study. One widely cited finding is that the best performing investors, when researchers looked at actual account activity, were people who'd essentially forgotten they had an account at all, never tinkered, just stayed invested. The second best performers were people who died, their accounts sitting untouched, quietly compounding. The FTSE 100 is what most people here mean by the market, the 100 largest companies on the London Stock Exchange. Globally, you'll also hear about the S&P 500 in America, hugely popular with UK investors too through global tracker funds, along with the Dow Jones and the tech-heavy Nasdaq. Right, here's what you actually do with all this. Open a share dealing or ISA account with Vanguard, Hargreaves Lansdown, AJ Bell, Freetrade, Trading 212, all reputable UK platforms. Start with index funds, a broad global tracker, or a FTSE 100 fund inside a stocks and shares ISA gives you hundreds of companies instantly, almost no fees, and better long-run results than most professional managers, purely by doing less. Automate it. Set up a transfer from your current account into your ISA every payday, so emotion never gets a say. Increase your contributions over time, starting at whatever you can manage and nudging them up with every pay rise. Ignore the noise. Financial media profit from your attention, so they're constantly shouting about crashes. Check your portfolio once a quarter, not once a day. And keep learning, because there's always more to understand about business, tax, and your own psychology. Here's the honest truth to close on. The stock market is one of the most reliable wealth-building tools available to ordinary people, but only if you actually use it. You can watch this whole video, feel motivated for an afternoon, and do nothing at all. Or you can open an account this week, invest your first £100 and start building something real. Every single person who's ever built wealth through investing started exactly where you are right now, confused and not entirely sure. The only difference is they started anyway and kept going even when the market crashed, which felt frightening. 20 years later, they have real financial freedom, while friends who waited for the perfect moment are quite often still waiting. If investing still feels like the missing piece for you, tell me in the comments what's holding you back. I read everyone. If this made the whole thing click a bit more, hit like and subscribe so you don't miss the rest of this series. See you in the next video.